Okay. I'm trying to get how to get that full screen because we need it, but probably okay. Full screen, full screen. Let me try it again. And now press tab. Can you still hear me? Hello?
Yes, sir, we can hear you.
Okay, can you see it as full screen
Yes, sir.
and it's recording, right?
Yes, it is.
Okay, so now back to the syllabus. We are looking at strategy. We are looking at SFM, okay, and then we've looked at how SFM is structured. So for anybody that is taking SFM, you must have done some courses prior to you taking SFM. So this is how the ladder moves from your management accounting. The knowledge you have from management accounting is needed in performance management. Then that knowledge you have in performance management is also needed in financial management. So for those of you that missed financial management, you must know that they took some topics from strategic financial management. They also took some from financial management, and then that's what they included here. And then they replaced some courses in this level and also in financial management level. Okay, so after you've done your performance management, you've done your financial management, then you now go straight to strategic financial management. Now, the knowledge you have in strategic financial management is very relevant for your case study, especially when you're analyzing all the business, the business, okay? Where you look at we have a lot of ratios, we have some other this thing, financial models you need to perform, like looking at what's it called now? MPV and all those stuff. So it's very important. So that is it. You appraise the business. Okay. So then we look at the main competencies. You can all look at this one in your spare time, but I want to look at the main area. So prior knowledge, the strategic financial management assumes and develops on the core knowledge and technical skills covered in financial management, performance management, background knowledge in management accounting, financial reporting, business environment, corporate and business law, etc. Then the ethical issues now. Applicable ethical codes will be those issued by the International Ethics Standard Board for Accountants and ICAN. This ethical consideration will be at both the organizational level and for individuals, particularly with respect to the accountants in business. Then we're going to look at method of assessment. Okay, the method of the strategic financial management paper is for 3 hours. Okay, all those will be gotten when you get to the exam hall. So now here is it. This is how they now broke it down. The first one, the introduction to business strategy and financial management, is taking 10 out of the whole total 100%. Then we have strategic management is also taking 10. We have risk management is 5. We have governance is 5. So you discover that most of the things we had in CSME, they are bringing it back into this place. Okay, you see a lot of models. Okay, just like we have in CSME before, you come across a lot of models. Then we have advanced investment appraisal. So this is where we start seeing all the calculations and all that. Then we have acquisition measures, then corporate restructuring and reorganization. Then we have advanced risk management techniques. So if you can do all these, I think the highest is this advanced investment appraiser. So this is the largest part of the syllabus. Okay, so even at ACCA level also, it always forms the largest part of the syllabus. So that means that as a student that want to really strategize and pass ICAN, you need to you don't need to take this section E. You don't need to take it for joke or levity. You need to look at it very well. Okay, it's taking 30%. Then we have the other one is taking 25%. Then advanced risk management is taking 15. So if you can focus on these three, okay, then you also take some AB, do AB, okay, then go to E, F, and G. You can concentrate on those ones. Believe me, you can make 90 in the exam. Okay, so it just depends on how strategic you are. So for that 10%, the first one is introduction to business strategy and financial management, where we talk about the roles, the responsibilities of senior finance executive slash advisor. So when we look at that, then let's go to the next one. I know you should be able to go through all these in your spare time. So I don't want to waste time on all these. Then we'll go to section B when we have strategic management. So this one also is 10%. All these ones are areas that you can read. Under this one, we have strategic analysis, okay? Analyze and evaluate an organizational purpose in terms of its stated mission, objective, and critical success factor, highlighting omissions, inconsistencies, and weaknesses, and considering the different objective of the stakeholders, okay? You all know the stakeholders of a business. So let's continue. The stakeholders are people that have interest or they have a stake in the business, okay? So let's continue. Let's look at other areas, like the main area where we have the largest mark is where I'm going to start from today, which is advanced investment appraiser. So we also have risk management. So and this risk management, it takes 5%. Okay, so you analyze and evaluate the key internal and external business risk evaluation, okay, and evaluate their impact on the attainment of strategic objective, operational efficiency and effectiveness, reliable reporting, and legal, regulatory, and ethical competences. So if I'm too fast, you need to let me know. If you like the pace at which I'm going, you also need to update me. So now let's move on. All these ones are things you can read on your own. It's just 5%. So you should be able to read it on your own. Then the next one, governance. Like go through the syllabus is what I'm saying. You need to go through the syllabus. And once the updated study pack is out also, there are areas that you should start concentrating on, start reading them at your own spare time. So where we have governance, under governance, we have something like agency theory, transaction cost theory, stewardship theory, resources dependency theory. So we have a lot of theories here: system theory, stakeholders theory, psychological and organizational perspective theory, and so on and so forth. So this also explain the nature, significance, and scope of enterprise governance and threat to effective governance, including concept of good governance, roles of internal and external auditors, board structure, audit committee, etc. So we also move on from there. Then let's look at the most, so this is investment appraiser, advanced investment appraiser. So under this, we look at discounted cash flow techniques. So we are going to evaluate complex capital investment using net present value. I told us. So, and the internal rate of return, IRR method, including specific and general inflation. Okay. Taxation is another one. Taxation is another one. So these are the areas you need to concentrate on them. You need to have a good knowledge or a good grasp of these: inflation, taxation, capital rationing, multiple period rationing. Okay, multiple period rationing, sorry, limited to discussion only. Okay, then probability analysis, sensitivity analysis, certainty equivalent, risk adjustment, discount ratio, rate, discount tree, and so on and so forth. Value of perfect information and value of imperfect information, project duration as a measure of risk, and then simulation. After that, we look at establish the potential economic return, modified internal rate of return. Okay, that is the modified. So discuss the relevant merit of MPV and IRR, evaluate an organizational commitment to ESG, okay, when undertaking business, financial, and investment decision, and explain the and profile solution on how conflict between the criteria may be resolved. So evaluate and discuss the impact on the physical environment and the sustainability of natural resources arising from alternative organizational business, financial and investment decision. So you evaluate capital investment decisions using advanced capital budgeting techniques that incorporate strategic factor. So also application of option pricing theory in investment decision. So we are going to look at all those things, utilize the Black School option pricing model to financial product evaluation and financial product valuation and assets valuation. So I think with these that we've looked at, we can go on and start um, working. So valuation and the use of free cash flow is another one. Utilize the adjusted present value techniques to the appraisals of investment decision that entail significant alternations in the financial structure of the organization. So let's look at the one that has 25%. So acquisition measures, corporate reconstruction, and free organization. This is 25%. So under this one, we're looking at acquisition and measures versus other growth strategies. We're also looking at, we're going to discuss the arguments for and against the use of acquisition. Sorry, let me just admit someone. Got it. Sorry, let me admit someone. Wait. I hope we are still together.
Yes, sir. We're together.
All right. So that's that. So in order not to waste time on this alone, I know you can go through this yourself. I'm going to send it to the platform so that you can have the syllabus, and with it you can look at everything that you need to concentrate on in that exam, so that you can also monitor your success. Okay, then we're going to look at advanced risk management techniques. Okay, this one is going to take 15%. We're going to look at the role of the treasury functions in large organizations. So we're also going to discuss the roles of the treasury management functions within, okay, the short-term management of the organization's financial resources, the long-term maximization of corporate values, and the management of risk exposure. I'm also going to discuss the operations of the derivative market, including, so all those things is what we're going to look at. So let's start now. After that, then we are going to come back to advanced taxation, but let's first of all face what we have currently. So, which is strategic financial management. So let me quickly open the file we are going to use today for this class. Okay. Okay. So can you see the screen?
Yes, sir.
All right. So now this file I just opened now, these are the things that it contains: advanced investment analysis, MIRR, that is modified internal rate of return. We have FC, free cash flow, okay, to free cash flow. Then we have free cash flow to equity, and then duration. We have capital rationing and cost of capital. We have advanced investment analysis, okay, two, gearing, cost capital. Then we have CAPIM, WAC, whatever. Then we have international investment appraiser. We have business valuation. We have valuation measures, acquisition, foreign hedge, exchange rate risk. So let's look at the first one, advanced investment appraiser. So now, prior to now, I know a lot of people, they are already used to the non-discounting cash flow techniques, okay? So, but when we come to advanced investment appraiser, they assume that at the lower stage, when you are in your PM performance management level, or now that you have financial performance, they assume that you should have done the investment appraisal at that level. So under those stages, they look at what they call the non-discounting cash flow techniques. But when you come to this advanced stage, you're going to be looking at the discounting cash flow techniques and the use of free cash flows. So let's quickly look at it, an overview of what we have to look at. Discounting cash flow techniques are investment appraisal techniques which take into account both the time value of money and also total profitability over the project life. Now, when you talk about discounting, discounting is always used when we are looking at when we have data that talk about the future. Okay, you have to discount them to the present value, because in accounting we don't use future value. We look at the present. Okay, you also talk about what we call accrual concept. Accrual concept says that in your statement of financial position, you should recognize expenses as soon as they are incurred, okay, and then revenue as soon as they are earned. Okay, so that is accrual. So you recognize it in the period in which it happened. So also this discounting, now you cannot say there are some cash flows that you're expecting in the future and then you are now using future term. You have to bring it back to the current term. So that is why as a financial management, as a financial manager, you need to know the discounting cash flow techniques, because you have to start learning how to project, do budgeting, and a lot of other things. So you need most of these investment appraisal techniques to be able to do the proper analysis that you need to do for your organization, so that your managers can take so that your the management can make appropriate investment decision. Okay, so let's delve into it. So discounting cash flow techniques are investment appraisal techniques which take into account both the time value of money, okay, and also total profitability over the project life. So two things are important under this advanced investment appraisal. We talk about the time value of money. Okay, the time value of money is very important. Okay, time value of money is important. Let me color it so that you see it. Time value of money, and also we also talk about the total profitability over the project's life. If you can hear me and we are together, let me know. Can you hear me? Are we together? Can you hear me? Are we together?
Yes, sir.
Okay, so they say it is therefore superior to both the ARR and the payback method of investment appraisal. So when you talk about the ARR, we talk about the accounting rate of return. Okay, so those are the things that you did in your lower stage. Okay, and also the payback method and all that. So yeah, we're looking at advanced techniques. So under this technique now, two things are important. The time value of money is important. You need to discount it because of the time value of money. What is the current value of that money? We are expecting cash flows to accrue in the future, but what is the current price of that money today? So also we also look at the total profitability over the lifetime of that project. So they say it is superior to the ARR and the payback method of investment appraisal. Then straight we look at the discounted method that we have. We have the net present value. We are just going to look at them briefly. Then we're not start taking them one after the other, and we focus on them. We solve questions on them. We understand everything that we need to know about them. So here now we have net present value is one of them. We have internal rate of return, that is IRR. We have modified internal rate of return. We have discounted payback period. We have duration. We have profitability index. We have adjusted present value. Now, the assumed objective is to maximize shareholders' wealth. So when you know all these things, if you apply them to each of the projects, you discover that at the end of the day, you are learning how to maximize shareholders' wealth, because you'll be able to advise management that no, this investment is not worth it. Don't do it, or go for this investment. This is how we can manage the resources we have at our disposal. Don't waste it on this project, because the project is not going to give us a positive MPV. You understand? You start speaking like a professional that you are. So let's look at the net present value. The MPV of a project is the value obtained by discounting all the cash outflows and inflows at a chosen target rate of return. So now this one, the NPV of a project, okay, is the value that you obtain. You obtain that value when you discount, it has to do with discounting. You discount all the cash outflows, okay, and also the inflows at the chosen target rate of return or cost of capital, and taking the net total. When we get there, we are going to look at everything. Everything is going to be easy. You must know that when you are investing in a project, there's a cash outflow. How much did you invest in the project? Okay, you will look at the cash outflow that you invested in the project. Then also, what are the inflows that is coming in? We know that we project that the inflows are going to be like maybe for 5 years. Then we discount them to present value so that we can make informed decision. Okay, so you look at, is this method is used when you want to is the value you get from using NPV is the value that arise after you've discounted all the cash outflows, the cash invested into the project, and the inflows. Okay, and then what do you use to discount it? You use a cost of capital, a target rate of return, okay, or cost of capital, and you now take the net total of it. Now that is the present value of inflows minus the present values of outflows. So under the when you are still at the lower stage, they tell you that NPV is the present value of future cash flows minus initial investment. But that is for the lower stage. It's for the lower stage. So at this higher stage now, you now say NPV equals to present value of return phase cash flow, okay? Return phase cash flow minus present value of investment phase cash flows. So we have two cash flows. We have the one that we get from the return phase, and we have the one that we get from the investment phase. So all we just need to do is that we just need to get the present value of the return phase cash flow. You now minus the present value of the investment phase cash flows. Now, when you are doing NPV, three things are very important. There are three things that are important. So there are three variables required in calculating NPV. The variables are, number one, the number of years of the project. You need to determine the number of years of the project. Is very important. Then you also look at the relevant cash flows. Not all the data that they give you in the question is relevant. Some cash flows are not relevant. We are going to look at what make up relevant cash flows. Then we're also going to look at the appropriate discounting factor. That is the cost of capital. So there's an appropriate discount factor that you need to use for a type of cash flow. It's not any kind of cash flows, or any kind of discount factor that you're going to use to discount your cash flows. It has to be, they have to be able to rhyme, okay? It's not like you are using a cash flow that is different from the kind of discounting factor that you're using. Both of them should be able to rhyme, okay? So let's now look at the decision rule now. When you are looking at this present value, I told you it's very easy. Just look at the present value of the return phase cash flows, present value of the return phase cash flows minus the present value of the investment phase cash flows. Once you've done that, you will get the NPV. And they now say that there are three variables that are required: the numbers of years of the project, the relevant cash flows, and the appropriate discount factor. Let's look at the decision rule now. If NPV is positive, what does it mean? After you've done your calculation and you discover that your NPV is positive, it's what does this signify? So when your NPV is positive, okay, then the cash flows, the cash flows from the investment will yield a return in excess of the cost of capitals, and so the project should be undertaken. The cash flows from the investment will yield a return. In excess of the cost of capital, and so the project should be undertaken. So whenever your NPV is positive, what does it mean? It shows that the returns that you are getting from the project, okay, it's more than the cost that you imputed into the project. For instance, if we invested like 50 million into the project, okay, that is our probably the cost of going into the project, or maybe this NPV now, you might also need it maybe when you want to borrow money. Maybe you want to borrow money from the bank, and then you are trying to analyze your investment. You are trying to analyze the investment to know whether it is worth it. Okay, you are trying to analyze your investment to know whether it is worth it. You discover that you need to check if I'm borrowing money at this rate. Okay, what is the return? What is the IRR of the project? Okay, what is the internal rate of return of the project? So once you discover that the internal rate of return of the project is higher than the cost of capital, okay, then it shows that the project is viable. Okay, it shows that that project should be undertaken. So if the internal rate of return, they say internal rate of return is that returns that make the cost of capital equals to zero. So that make the NPV equals to zero. Sorry. So internal rate of return is that returns that make the NPV of the project zero. That means that the NPV of your project, you are not making a loss. You are not making a profit. You are at break even. So if your IRR, your internal rate of return, is higher than the cost of the capital that you use for the project, then the project will not make a loss, for instance, because your IRR, your internal rate of return, is higher. That's at your internal rate of return, they've calculated it that you cannot make a loss. At that position, your NPV is supposed to be zero. Okay, so if that's your IRR, your internal rate of return, is not higher than your cost of capital, that means that you are not going to make a loss from the project. The project is viable. So now they say that if your NPV is positive, that means your NPV is not negative. Your NPV has gone past being zero. You know that when your NPV is zero, that means you are at your IRR level. Your NPV is zero. But now it has gone past zero, is now positive. So if your NPV is zero, that means that you are not going to make a loss on the project. You are rather going to make a profit from the project. Are we together? Please, somebody unmute and let me know we are together.
Yes, sir. We are together.
Okay, so all right. Sorry, just give me 2 minutes. Okay, so that is that. So if your NPV is positive, that means that you are not going to make a loss. You've broken even. When your NPV is zero, you break even already. So if it's not positive, that means that you are now making profit. But if your NPV is negative, that means that you have gone below the break-even point and you are making losses. So that's why your NPV must be positive. That means that when your NPV is positive, you are already making profit on that your project. So they say, okay, let's leave that. Then let's say if your NPV is negative, you know what it means. The cash inflows from the investment will yield a return below the cost of capital. You know, I've already mentioned this return that I'm talking about, internal rate of return. So it will yield a return below the cost of capital, and then the project should not be undertaken. So now I told you that at these returns that they're saying, that return is set in a way that at that return you can never make loss. You are going to break even, okay, at this return. They call it the internal rate of return. So once you are at the internal rate of return, you can't make loss. You are just going to break even. But if you are now below the internal rate of return level, that means that you are not going to break even. You are going to make loss. But if you are above the internal rate of return level, you are going to be making a profit. That is, if your NPV is positive, that means that you are above the internal rate of return. You are above the internal rate of return. That's what it means. So, but because at the internal rate of return, your NPV is supposed to be zero. That means that at it is zero, you are not making profit. You are neither making loss. But when your NPV is now positive, that means that you are now making profit. But if your NPV is negative, you are below the internal rate of return level, and then you are making a loss. Okay, now then I say that if the NPV is exactly zero, then the cash inflow from the investment will yield a return which is exactly the same as the cost of capital. So in that case, you are not going to make profit, neither are you going to make a loss. Okay, so the company should be indifferent between undertaking the project or not undertaking the project. So that is what I've analyzed here. So when you are positive, you are making a profit. When you're negative, you're making a loss. When you're making a profit, accept the project. At this stage of making profit, your internal rate of return is higher than your cost of capital. At this stage where you are making a loss, you have to reject the project because your returns is lower than the cost of capital. But at this stage where you have zero, that means that you are neither making a loss or making a profit. So you can decide to accept the project, you can decide to reject the project. It doesn't make any difference. So you can be indifferent at this stage. So that is what the totality of what NPV is about. So once you are able to understand this, then we're now going to look at the other things that you need to consider: taxation, inflation, how to get the relevant cash flows and all those things. That is where the work is. So we are going to look at that when we get down. But I just want to give us this overview first so that we understand what NPV is. Hello, hope you understood what NPV is. Just the overview from here.
Yes, sir.
Okay, so now let's now go straight to economic rate of return. In other words, they call it internal rates of returns. Okay, so just give me 2 minutes. Let me just attend to something. So economic rate of return or internal rate of return. So under this economic rate of return, they also call it IRR. I told you that is that returns that they say that will make the NPV to be zero. Okay, at this rate, you are not making profit, you are not making loss. So now they now say that internal rate of return is that discount rate which gives a net present value of zero. Alternatively, the IRR can be described as the maximum cost of capital that can be applied to finance a project without causing harm to the shareholder. So the maximum, maybe you are going you want to embark on a project, for instance, and then you've gone to the bank. Bank is telling you that to take loan from us, you need to pay so amount of money. To take loan from us, you need to do this, you need to do that. So you now discover that you as a finance manager, you don't just accept what the bankers are saying. Okay, you need to also do your own internal calculation. Okay, if you are taking this loan at this rate, what is the return phase of this project? What is the percentage of returns? What is the discount rate of the return? Because the bank will tell you is the cost of capital, the rate at which they are going to give you that loan. So you also, as a finance manager, you need to also do your own rate of return. What is your internal rate of return? This project, what is the highest cost of capital that we can use for it? That no matter what, we cannot go past this cost of capital. You need to calculate it internally. That is what this economic rate of return is about. Okay, so now they say the internal rate of returns is that discount rate which gives a net present value of zero. Alternatively, the IRR can be described as the maximum cost of capital that can be applied to finance a project without causing harm to the shareholder. It is sometimes called the yield of DCF or DCF yield or internal yield or discounted rate of return, whatever the examiner calls it in your exam. Okay, they can tell you, give us the DCF yield, give us the internal yield, give us the discounted rate of returns. So that is another name for the IRR. They can also tell you economic rate of return. So you must understand that is what they're talking about. So before you go to the IRR, you must first of all know how to get your NPV. Your NPV is very important. So it is something we've done that. So they say the IRR is found approximately using interpolation. This is giving us, so we have the lower rate. Okay, we have we have the lower rate plus this lower rate we are talking about is like discount or cost of capital. Okay, you have the lower rate, then you have the higher rate. When we start, you start understanding how to how to do all these things. So we have the lower rate is 10%. We have the higher rate is 5%. So when you want to input it in this formula, you just say the lower percentage, okay, plus you open your bracket, MPV of the lower rate. So the MPV that you got when you use the lower rate, you are going to put it here. So you have the lower rate plus MPV of the lower rate, okay, divided by MPV of the lower rate minus MPV of the higher rate. Okay, once you have done that, that means that in this, whenever you are doing internal rate of returns, you need to have gotten two MPVs. You need to have gotten two MPVs. And when you are doing internal rate of return, they can give you a lower rate. They can give you one cost of capital, and then you need to predict what the other one is. Okay, it's like a trial and error something. You need to predict what the next higher rate will be. Okay, either by adding to it or multiply by 2 or so on and so forth. So now we have to get IRR, you need a lower discount or a lower cost of capital, okay, which this lower cost of capital is what you have used to get your MPV of the lower rate. So the lower cost of capital that you use to get the low MPV, okay, you use it, you now say plus MPV of the lower rate divided by MPV of the lower rate minus MPV of the higher rate, multiplied by the higher rate percentage minus the lower rate percentage. So I just gave us an example here where your lower rate is given as 10%. Maybe when you are trying to calculate the first MPV that you got, you use 10%, okay? Then the next one, you now say, okay, if this my MPV is giving me a positive one, let me now try another discount factor. So you now try a higher discount factor, okay? You know that when you try a higher discount factor, you know, I told you that when your MPV is positive, remember I told us, your MPV is going to be positive at that point where your IRR is greater than your cost of capital. Your IRR is usually at that place where your MPV is 0, okay? So now when you use a cost of capital that is low, remember that the lower the cost of your capital, the higher the MPV that you are going to get. So when you do a low cost of capital, your MPV is likely to be positive because when you compare your MPV, which is your MPV, okay, for it to be positive, your IRR must be greater than your cost of capital. I don't know if I'm confusing us. Hello, am I confusing us, please? Hello?
No, sir.
I'm not confusing us. Okay.
No.
I need to be sure. So
No, sir.
now when you are doing that, you discover that your lower rates, when you have a lower rate, okay, your cost of capital, if your cost of capital is small, you discover that your MPV is likely to give us a return that is positive, in the sense that this is the cost of capital that the bank is saying they are going to give you that loan for. Maybe they say they're giving you the loan for 10%. But you as a finance manager, you should have calculated your own internal rate of return to know what is the highest cost of capital that you can take that loan from the bank. What is the highest cost of capital? So use your IRR to calculate that. So now, when you now take a lower cost of capital, okay, when we compare the lower cost of capital to the highest cost of capital that you can ever use for that project, you discover that your MPV is going to be positive because your IRR is greater than your cost of capital. Your MPV will likely going to be positive. So that lower cost of capital that you are using is what you are going to use as your lower percentage plus the MPV of the lower percentage. The MPV you got when you use a lower percentage, that means that MPV is likely to be a positive MPV. Okay, you now divide it by the MPV you got when you use a lower percentage minus MPV you got when you use a higher percentage. Remember, when you use a higher percentage, your MPV is likely to be negative because when you compare the IRR to the cost of capital of a project, if the cost of capital, the bank is saying they are going to give you a loan at 50%, and then when you now calculated your IRR, you now discover that the highest you can ever take that loan is maybe like 30%. You discover that the cost of capital that the bank is saying the interest rate they are giving you is higher than what the highest cost of capital that you can ever use for that project. So when you use a higher cost of capital, it's likely to give you a negative NPV. So if you understand this concept now, then we can move on. Do we understand it?
Yes, sir.
Okay, so we understand it. So now this formula that we have up here is what we now imputed down here. We now say 10% plus, we just assume that when we use 10%, we got 190 as a positive NPV. We now divide it by the lower NPV that you got when you use the lower cost of capital minus the NPV you got when you use the higher rate. Okay, you now multiply it by the higher rate percentage minus the lower rate percentage, and that is going to give us mathematically, going to give us 10% times 7.6%. It's going to give us 17.6%. So that means that when you are going for that loan, okay, the maximum you can take is 17.6%. So at this 17.6% is that percentage at which your NPV is likely to be zero. Okay, so if you go for any loan, okay, that is 17.6%, okay, the cost of capital is 17.6%, you are not going to make any profit on that project because that is your IRR. And they assume that at the IRR rate, your NPV is equal to zero. That means that at that rate, you are neither making a profit nor making a loss. So I'll be back. Just give me 2 minutes, please. Let me check. 2 minutes, please. Okay, so I'm back. I'm back now. Let's continue now. All right, so now the decision rule now. This is the decision rule. If the expected IRR, okay, that you got exceeds the cost of capital of the project should be, if your IRR is higher than your cost of capital, okay, you've calculated your IRR, your internal rate of return. Look at it that, okay, your internal rate of return is that rate of return that when you employ it in that project, your NPV, you are likely to break even. So when you calculate your IRR and you discover that this your IRR is greater than your cost of capital, what does it imply? It implies that the bank say that they will give you the loan at 10%. But when you calculated your IRR, your internal rate of return, you now discover that the highest you can go for that loan is 15%. So now if the bank is giving you at 10%, I mean, that means that you are going to make profit now. If the bank is giving you that loan at 10%, sorry, and then you, as a finance manager, you've calculated your IRR and discover that the highest you can do, okay, the highest you can do is, let's use this example we have. The bank is saying that they are going to give us the loan ranging from 10% to 15%, okay? However, when we calculated our IRR, we now discovered that our IRR is 17.6%. Now, this 17.6% is a cost of capital that once you use it for the project, the NPV of the project is going to be zero. The NPV of the project is going to break even. You are not going to make a loss. You are not also going to make a profit. But the bank is telling you that they are going to give you the loan ranging from 10% to 15%. I mean, as a finance manager, what will you tell the organization? Somebody should unmute and let me know. Hello.
The project.
I can't hear you.
I said I have to take the undergo the project.
Yes. So is that the final answer? Does anybody have a separate opinion? Does anybody have another opinion? Please respond though, so that we can move on. There are lots we need to do before. Okay, so that is that. So let's continue. Let's continue. So now the decision rule. Now you already know this decision rule. I don't need to go through it again. You already understand the decision rule. If the IRR is higher than the cost of capital, accept the project, because at this IRR, that means your NPV. If it's higher than the cost of capital, then definitely your NPV is going to be positive. Now, if your IRR is lower than the cost of capital, now the reason why your NPV will be positive is because you are not doing the project at the IRR. No, you are doing the project at a cost of capital that is below the IRR. Remember that if you do the project at the IRR, the NPV would have been 0. But you are not doing the project at a cost of capital that is lower than the IRR. That's why your NPV now will not be positive. The second one, if the IRR is lower than the cost of capital, please reject the project, because if you have done that project at the IRR rate, the project would have broken even. But because you are not doing the project at a cost of capital that is higher, the IRR here is lower than the cost of capital. So definitely the project can never break even. The project is going to make a loss. So that's why they say you should reject the project here. So let's move on to this other one. After that, once we have done with this one, then we now go to the relevant cash flow. Now we are going deeper into NPV when we start going to relevant cash flow. So now for discounted payback period, they say it is the length of time the present value of a cash flow from an investment recovers the original cash outlay required by the investment. Through the discounted payback method, the normal payback period problems of time value of money is resolved. So now they criticize the they criticize the former payback period because they say it doesn't consider the time value of money. But now they now modify this one. Now this one is now called discounted, because this one is taking into consideration the fact that that money that you are paying back in the future, that money, the value may not be the same. For instance, I borrowed you money. Maybe I borrowed you 150 million now, for instance. You have that debt. Then you now invested, or you are trying to calculate that, okay, if I should invest this 150 million in this project, what are the cash flows that I'm likely to get from this project? And then when I'm using those cash flows to settle all this obligation, at what time will I finish settling those obligations? Okay, so once you do that, once you do that, okay, once you now employ the discounted payback period, that discounted payback period is going to consider that, okay, that cash flow you say you are expecting in the future, can that cash flow be the same? Let's say like you are expecting 150 million in the future. Somebody gave you 150 million today. That same 150 million that you are expecting in the future, will it have the same purchasing power as the cash flow that you received today? So that is where the discounted payback period comes in. So it is the length of time the present value of cash flows from an investment recovers the original cash outlay required by the investment. Through the discounted payback method, the normal payback period problem of time value of money is resolved. Now the decision will now accept the project if the discounted payback period is lower than the targeted discounted payback period. Probably the person that is giving you the loan, okay, is saying that, okay, is expecting, or maybe the company, they made a budget that, okay, yes, in the next 3 years, we should have finished paying back this loan that we took from these people. Okay, probably that is the budgeted, but you now calculated it as a finance manager. You calculated it using the discounted payback period to check whether what we actually did is actually correct, because we assume that, okay, in the next so period we should have done so and so. But they are telling you that CO is not possible because as a finance manager, we've considered the time value of money. And then we now discover that, okay, this your payback period, probably we are going to pay it back in so time. You need to compare that discounted payback period. You need to compare it to the targeted payback period. What does it mean? It means that in your question, the examiner is going to give you a targeted payback period, which when you have gotten your own discounted payback period, you now compare it to what the examiner gave you. They can say a company is going for 150 million loan, and then their targeted discounted payback period is 3 years, for instance, 3 years. So when you calculate your own, you now compare it to what the examiner has given you in the exam, okay, and check if that one you got is lower than the targeted payback period. That means that project is worth it, is worth going for. So you are advised that please go for the project, because this project will give you cash flows that you can easily pay back the loan. Maybe they are expecting that you should pay back the loan in 5 years, but when you calculated it based on your analysis, you now discover that you can actually pay back that loan within 2 years. They say, why not? Go for the project. The project is worth lower. Since the cash flow is going to be enough to pay back the project. Are we together? Do we understand that? Can I move on? Any question, any observation, any concern? Hello? Can you hear me? Any concern, any observation, any question from us?
No, sir.
All right. So moving on. I assume that majority of us, we have the knowledge of most of these things from the past. Okay. So now let's now look at relevant cash flows now. Now remember that, let's go back to that MPV. You know that I told you that to get MPV, you need 3 things. The first one is you need the numbers of years of the project. In your question, they are going to give you these numbers of years. You don't need to calculate these numbers of years, no. But the things that you need to consider is this relevant cash flow. How do we know the cash flow that we should use for the project? That's number one. Number two, we also look at the appropriate discount factor. What does it mean? It means that it's not the discount factor that you are giving, that there are some things that you may need to do to that discount factor. So yes, there are some things you may need to do to that discount factor before you can use it to discount that cash flows. So number one, you need the appropriate number of years, the numbers of years for the project, which will be given in the question. Number two, you need the relevant cash flows that you need. Then the last one, you need the appropriate discount factor. And also remember, when you're doing MPV, you are saying the present value of the return phase cash flows, you minus it from the present value of the investment phase cash flows. But how do you know all the cash flows that are relevant? How do you know the cash flows to use for this operation? How do you know it? That is what we are trying to go and look at. What are the relevant cash flows that we should take note of? Okay, the relevant cash flows that we should take note of. So let's look at it. A relevant cash flow is a future cash flow arising as a result of a decision. So a relevant cash flow is a future cash flow arising as a result of a decision. The cash flows that should be included are those specifically generated or incurred as a result of accepting or non-accepting of the project. Let me give you an example. An example is that, we have investment phase cash flow. Maybe the costs you are incurred on the project. Maybe you are paying workers. Okay, you need to check. These workers, are they full-time workers? Do they have, what do they call it when people are idle? Do they have idle time? Okay, do they have idle time? Do I need to give them overtime? Okay, do I need to employ additional hands for the job? This is when it has to do with workers, laborers. Okay, so a lot of things come to play when you're looking at relevant cash flow. Remember, you have to look at the present value of the investment phase cash flow. Investment phase cash flows, we have to do with all the costs that you incur in the project. Then you also look at the present value of the return phase cash flows. all those return phase cash flows, you need to minus the cost from the revenue. It's simple. When you are doing this net present value, you need to have what we call the revenue, the return phase cash flows from the project. You have it as your sales. Then you have your cost, the cost that you incur. That is the investment phase cash flows. You need to add them. Okay, once you add them, then you now discount those things to present value. That is all NPV is about. Once you are able to do that, you are good to go. So they say a relevant cash flow is a future cash flow arising as a result of a decision. That decision is either the decision that you took when you entered into that project. But if that cash flow does not change, whether you do the project or you don't do the project, that means that cash flow is not relevant. For instance, maybe I say, okay, I want to start a factory in a place. Then before we started the factory, I already called people, laborers, to come and clear the bush, to come and clear everywhere. Now, for the fact that they cleared everywhere, doesn't mean that when I now start the factory, I will now put that cost that they used to clear the factory. Sorry, they used to clear the bush. I will now put it as a relevant cost, because the fact that they cleared that bush doesn't mean that I will continue to do that project. I may decide to abandon that project. So where will I charge that cost to? That means that cost that was incurred at that particular time is not relevant for the project at hand. So that is what the concept of relevant cash flow is all about. Now they say the cash flows that should be included for this specific are those specifically generated or incurred as a result of accepting or non-accepting of the project. Relevant cash flow should be judged on the basis of, number one, incremental cash flow. For the fact that I did that project, are the cash flows incremental? The cash flow, are they incremental? The cost, the initial stage, investment stage cash flow, did I incur more costs because I embark on the project? And also, you also look at on the basis of avoidable cash flows. Okay, avoidable cash flow. Maybe like that cash flow or the cost, I would not have incurred it if I did not do the project. So will I have avoided that cost? You ask yourself that question. Okay, this thing now that I'm embarking on now, this cost, if I didn't do this project, will I have embarked on the cost? So let me give you an example. Okay, are you with me? Can you hear me?
Yes, sir.
Okay, so let me give you an example. Let's say I was called by someone, a student, say, okay, come, because now I'm at on the mainland now. Then a student calls me and say, please come to the island to come and teach us SFM today. So I look at it. From here to island, probably I'm going to incur maybe like 3,000, 5,000, or whatever it is. So I now say, okay, this transportation cost that I'm going to use to island, can I add it to the cost that I incurred for going to teach these people? So I now ask myself, is this transportation, is it avoidable? That means that if I don't embark on this journey to go and teach this person, will I still pay this transport fare? That means that if normally today, Saturday, my route, I'm supposed to go to the island before today, okay? That means that whether or not somebody calls me to come and teach them or not, I'm going to incur that money on transportation. So I'll ask myself, if I go for this teaching today, will I still incur this transportation cost? If the answer is yes, then that cost is not relevant. If I am going to the island before, maybe I have a business to do in Ireland before, okay? And then a student now calls me and say, okay, come to the island. That means that when I am giving that student my contract costs, okay, I will not include transportation because that transportation is not relevant. Whether or not I'm called to come to the island to come and teach or not, normally I will still go to island today. So why will I factor in that cost of transportation in the cost of that project? So that is where relevant cash flow comes in. So now the cash flow that will be relevant for a project must be the one that is incremental. It must be a cash flow that is incremental. Okay, just give me 2 minutes, sorry. Okay, all right. So sorry for that. Sorry for that. Yeah, I was saying that yes, we are looking at the relevant cash flow. It's very important that we understand what the relevant cash flows are, so that anytime you see any MPV question, both at the foundation, sorry, both at this stage, both at what am I trying to say? Both at SFM level and also at case study level, you should know how to do MPV. MPV should not be your worry when you are thinking about case study. Okay, so the cash flow that I'm going to consider for any of my investment must be the one that is incremental. If I embark on that project, probably I'm going to incur additional staff cost. Probably I'm going to incur additional storage cost. Maybe I'm going to incur additional what is it again? Maybe I need to expand the warehouse that I'm keeping my goods. Probably before I took two bedroom for my warehouse, but because I'm doing this project, maybe I have to now expand from 2 bedroom. I need to go to like a 4 bedroom flat, or maybe 3 bedroom flat, and so on. So we look at those cash flows that are incremental. Those are the relevant cash flows. Avoidable cash flows. You ask yourself, these cash flows, if I should not embark on this project, is this cash flow is it avoidable? If the cash flow is avoidable, then know that the cash flow is relevant. Okay. Then we also talk about opportunity cost. What does opportunity cost talk about? Opportunity cost talk about the benefits that you forgo for embarking on that project. For instance, let's say I have a vehicle, and this vehicle, I normally use it to pick people. Let's say I'm into, I do Uber, okay? I normally use this vehicle to pick people from one place to the other, and they give me money. So let's now say that somebody now calls me and say, okay, there's a wedding in Ibadan. Can you convey us to Ibadan and all that? So I now say, okay, what is the opportunity cost of not going to pick people, not doing Uber? What is that cost? What is the opportunity cost? What is the money that I have forgone? What is the income that I have lost because I'm going to Ibadan for a day, for instance? So I'm going to factor it into what I'm going to give the person. For instance, let's say normally if I'm going to Ibadan on a normal day, maybe like I am not trying to apply opportunity cost. Maybe normally I would have charged people 500,000. That okay, I want to use my vehicle to pick you from Lagos to Ibadan. I would have charged you 500,000 on a normal day. But because I have another thing I would have used that vehicle for, probably I would have used it for Uber, and I would have been able to generate probably like 200,000 in a week, for instance. Then that week, I now say, they now call me that I should come to Ibadan. In giving the people my cost, I will not only give them 500,000. Why? Because as I'm leaving Lagos to go and help them in Ibadan, I have left something, an income that's supposed to come to me has been forgone. Okay, so that income, in order for me not to lose it, I'm going to add it to the cost of this job. Hello, are we together? Do we understand it?
Yes, sir.
Okay, so that is that. So let's also look at specific fixed costs. Normally they tell you that relevant cost, that fixed cost is not relevant, but not all the time. There are some fixed costs that you incur purposely because of the project. So they call those kind of fixed costs specific fixed costs. For instance, if they say normally in my warehouse I have 2 bedroom, I've given that illustration before, but because I'm embarking on this project, I have to expand my warehouse. Maybe I'm now, because of their project, I have to now take like 5 bedroom apartment. Okay, you discover that I cannot say that cost of getting that warehouse is not relevant, because that is a specific fixed cost. The fixed cost was incurred purposely because I had to take that project. So that's why they call it specific fixed cost. A student paid, and I'm supposed to add him to this class. Just give me 2 minutes. Let me add this student to the class. Professional level. Sorry. Sorry. So I don't know if this student also is taking SFM now. Let me just add him to the class so that we know that nobody is left out. Okay, so that's that. So specific fixed cost, as I said, yes, that is the one that is relevant. Then we have a directly attributable fixed cost is another one. So we can directly attribute it to this project because it's relevant. So they say specific fixed cost or directly attributable fixed cost are the fixed costs that would arise as a result of undertaking a particular activity. So those are the relevant cash flows. Now let's look at cash flows that are not relevant. Cash flow that irrelevant cash flows, they include depreciation. We already know that depreciation are non-cash items, okay? They are non-cash items, though on a normal basis in accounting, we allow depreciation in our account. But a taxman will tell you that depreciation is not allowed because the method of deriving depreciation differs for different entities. So the taxman, they have their broad or general method of depreciation. So that which is called capital allowance. So that is what they give in lieu of depreciation. So depreciation is a non-cash item. So that means that it does not involve the movement of money per se. It does not involve the movement of money. So depreciation is one of the irrelevant cash flows. Okay, it's a cost that is not relevant. So if you see if they give you your profit before interest and tax or so, you must know that they've charged depreciation before arriving at that profit. So you need to add back depreciation because depreciation is not relevant. So here they now say that it's a non-cash item. If profit is given after depreciation, the depreciation should be added back to get the cash flows. Now the next one is apportioned fixed costs. Now apportioned fixed costs or general fixed costs. So when they say something is apportioned, that means that it's a general fixed cost. It's a fixed cost that is common to everybody. So they now say, okay, they want to apportion it. Maybe let's say that normally the factory, we have a plant or we have a big generator, and that generator supplies the whole factory. Now, because we now have a project that we need to help sew army uniform, for instance, does not mean that we should apportion a portion of that electricity to that project because it's not actually relevant. Whether or not we embark on that project or not, we will still incur that cost. So that cost is not relevant. So for a cost to be relevant, it has to be incremental, it has to be specific, okay? It has to be avoidable, okay? It has to be incremental, okay? So that is what it means. So when they say that a portion fixed cost or general fixed costs, they are not relevant. Fixed costs may appear in a DCF calculation only if it is known that they will increase as a result of accepting a project. So that's why we talk about incremental or specific or directly attributable fixed costs. So we've looked at that, it's not relevant. Then we talk about interest payment. This is factored into the discount rate. So in a question, if they tell you that they've already charged interest, you must know that that interest is not relevant. Why? Why is it not relevant? The reason why it's not relevant is because your cost of capital that you're going to use to discount that project already has that interest. They already factor that interest into your cost of capital. For instance, maybe they say that 10%, they say 10% of 1,000, okay? 10% of 1,000, 10% of 1,000. So now you now took that 10% of that 1,000, and then you are now deducting it from the sales, okay? Or you are saying that, okay, that interest rate is relevant. You want to deduct it from the sales that you made. Okay, you want to deduct it to now know what is the net amount. No, it's not relevant. The reason is because this 10%, okay, is the only thing that is relevant, and it has been added to the cost of capital. But you see, this 10% of this 1,000, which is going to be like 100 naira, is not relevant. You cannot add it. You cannot deduct it as a cost. You cannot deduct it at a cost for the project. So now the next one, we also talk about sunk costs or past cost. When you talk about sunk cost, a sunk cost or a past cost is a cost that you have incurred. So, and then it does not make any difference in the project. It doesn't matter whether you do the project or not. That cost has been incurred already. It's in the past. So it does not form the basis of you making decision on that project. So when we now talk about notional cost, I want to give you guys notional cost as a an assignment. Okay, go and look at what notional cost is. Notional cost, I might be wrong, but this is what I think notional cost is. Now, notional cost is like a cost, is like opportunity cost. Hello, are we together? Hello?
Yes, sir, we're together.
Okay, so do you have any explanation for what a notional cost is?
No.
Any other person? Does anybody have an understanding of what notional cost is? Okay. So I want to tell them to join the class. We are working on investment appraisal. Working on investment appraisal. All right. So now notional cost is just like opportunity cost. Okay, just like opportunity cost is like, is a benefit that you thought you forgo, but you actually did not forgo it. Let me give us an example now. Let's say that, okay, I want to use they will always tell you that when you have, let me give you an analogy. They say that when you have a building and that building you are using it for your factory, okay, you should cost it. What is the cost of rent? That you should assume that cost, how much would you have paid? How much would you have paid to another person if you were to rent that same building outside? You understand that now? So that is what notional cost is. A notional cost is a cost that or is a benefit that you thought you will forgo, okay, for using that asset. So maybe I say, okay, I have a building. I'm using that building for my warehouse, okay, to warehouse things. So I now say, okay, because I'm using this building and I cost it, like, okay, a normal warehouse like this should go for 500 million, or maybe it should go for like 5 million per annum. Okay, so because of that, I want to add it to the cost of the project. No, you assume that you are foregoing 5 million. But in the real sense, nobody is actually coming to rent that warehouse. Assuming somebody came to meet you and say, okay, I want to rent your warehouse. And now you are in between making up your mind whether you are renting out the warehouse to the person or you are using that warehouse for your business. Okay, that time opportunity cost can come in. But notional cost is just like opportunity cost. You assume that you are going to forgo that cost or you are going to forgo that income. But in the real sense, nobody is actually coming to rent that warehouse. So for the fact that you are using that warehouse for your project doesn't mean that you should now say the rent of that warehouse, you want to charge it to the project. People do it, actually. People do it, but theoretically and in practice, what should be done, that kind of cost is a notional cost because it's an opportunity that you thought you will forgo, but you did not forgo it. Do we understand it?
Yes, sir.
Okay. Only one person is responding. I hope everybody understood it because you also still need this information for your. In fact, in SFM, you need. They always say that they will tell you that cost of capital WACC is the double entry of SFM. But if you don't know MPV, there are a lot of topics that you must have the knowledge of MPV. If you don't have the knowledge of MPV, you cannot solve them. So now that is what a notional cost is about. So now let's go straight to the next thing that is important. We've looked at the relevant cash flow. The next thing that we look at is working capital. Okay, now working capital. Now they say that some capital investment involves and investment in working capital as well as fixed assets. Okay, now that's a working capital should be considered to consist of investment in stocks and debtors minus trade creditors. You know what they say working capital is? They say current assets minus current liability, you get your working capital. Okay, so in when you are working on a project, also they also give you what they call working capital. Okay, probably you say at this stage of the project, I need 10 million. Okay, at the next stage, I need 5 million. At the next stage, you keep financing the project. As the project is unfolding, you keep financing it. So they call those things working capital. Okay, they say some working capital investment involves an investment in working capital as well as some capital investment. Some capital investment involves an investment in working capital as well as fixed assets. So you need to continue to finance the project. Working capital should be considered to consist of investment in stocks and debtors minus trade creditors. Just like you say, your current asset minus your current liability. An increase in working capital reduces cash flows, and a reduction in working capital improves the cash flows in the year that it happens. Okay, now by convention in a DCF analysis, if a project will require an investment in working capital, the investment is treated as a cash flow at the beginning of the year in which it occurs. The working capital is eventually released or recouped at the end of the project when it becomes a cash inflow. So you remember, as you are injecting more money into that project, so that is working capital. You are injecting more money into the project. So at the beginning stage, they say that it is treated as a cash outflow because it's an investment into the project. So at the beginning stage, you jacket it. It's like a cash outflow. But at the end, you now recoup all of them. So maybe in year one, you invested additional money, 100 million. The next year, you invested 120. The next year, so all of them, you jacketing it. You put in bracket. At the end of the day, you now recoup all of them as an inflow. So now the next important thing is inflation and project appraisal. So what does inflation talks about? Okay, now this inflation is another place that we need to concentrate on. If you don't concentrate on inflation, you can calculate NPV and not get your answer because you feel that, okay, I've done everything right. But if you are not used to the concept of inflation, if you don't know how inflation affects your cash flow, if you don't know how inflation affects your discount factor, you just discover that you've done your NPV, but you are not getting the desired score. So they say inflation is a general increase in prices leading to a general decline in the real value of money. So inflation is everywhere. It's a general increase in the prices or in prices leading to a general decline in the real value of money. In general, the effects are the following. Number one, revenue increases, cost increases, increase in discount factor. So remember that whenever there is inflation, people that normally they will say you have to pay us, let's say like workers, everybody wants increase. Workers want their salary to be increased. Okay, the cost of buying things in the market also increases. Okay, then the cost at which bank will also give you loan will also increase. So it affects the revenue, it affects the cost, it also affects the discount factor. So that means that whenever you are looking at the concept of inflation, you must ask yourself, how does inflation affect revenue? How does the inflation affect the cash flows that I'm to use for this analysis? How does the inflation affect the discount factor? Because they say appropriate discount factor. You must know the appropriate discount factor to use for a type of cash flow. So now the first one, we can talk about money cash flow. When you talk about money cash flow, it's also called the nominal cash flow. So this kind of cash flow is already inflated. This is the inflated cash flow. So whenever you are giving a real cash, a money, when the examiner tell you that this cash flow is in money term, okay, they are telling you that it has been inflated. If they tell you that this cash flows is a nominal cash flows, it has been affected by inflation. Now, these are the predictions of the actual sums of money which will be received and paid, taking into account predicted inflation levels. The money rate of interest is the interest rate which is normally quoted and contains an allowance for inflation. For example, a 20% discount rate, okay, a 20% discount rate may contain an allowance for expected inflation of 5%. So when we get there, we are going to understand it. But all I need you to understand now is that um, understand that, please give me a minute. Understand that, okay, you need to understand that when the examiner is telling you that this cash flow is a money term, or when they tell you that is a nominal cash flow, just that that cash flow has been affected by inflation. So what it means is that when you are trying to select a discount factor, you make sure that the discount factor you are going to use is a discount factor that also matches the kind of cash flows that you are giving in the question. Are we together? Are we still together?
Mm.
All right, we are still together. I'm sure you are enjoying the class. Okay, so let's look at
Yes.
weak cash flow now. Then we are going to look at the relationship between the money. We're also going to look at the interest rate. Okay, we have real interest rate and we have money interest rate. Now, when we talk about the real cash flow, these are cash flows expressed in today term, in today prices. They have not been inflated. They are the cash flow that is expressed in today's prices. They have not been what? They have not been influenced by inflation. A real discount rate is the rate required. Sorry, a real discount rate is the real required rate of return after adjusting the money discount rate for the inflation allowance. So now what they're saying is that when you have a real discount rate, is a discount rate that you get after you factored away all the inflation. That means if the inflation is not affecting it. So that is what they call a real discount rate. Now let's now look at, I told you that whenever you are having a type of cash flows, you must be able to match it with the appropriate discount factor. Okay, that means your cash flow can either be a real cash flow or it can be an inflated cash flow. If your cash flow is in money terms, it has been inflated. If your cash flow, they say, is real, it has not been inflated. That means that you factored away all the inflation from the cash flow that you are giving. Now let's now look at a relationship between money interest, the relationship between money interest rate and real interest rate. Now, money and the nominal rate is used to discount the nominal cash flow. So you must match it together. When you have a discount rate, okay, when you have a discount rate that they say is in money terms, the discount rate is in money terms, you must be able to check the cash flow in the question. Are this cash flow also in money terms? It's very important. So when you are giving a money interest rate, is an interest rate that has been affected by inflation. You must be able to check your cash flows in the question. Are my cash flows also in money terms? If your cash flows are in the real terms, you need to convert. It's either you are converting the interest rate to the real term, or you are converting the cash flows from the position it is, you are converting it to come and meet up with the interest rate that you are giving. Okay, so um okay, so what was I saying? So yeah, so let's now look at this one. Now they say that the money or nominal rate, that is the inflated rate, okay, the inflated rate, okay, should be is used, sorry, the inflated rate or the money rate is used to discount the nominal cash flows. So it must be like and like. Nominal rate to nominal cash flow is very important. The next one, real rate, also is used for real cash flow, is very important. Remember that real cash flow is a cash flow that is not affected by inflation, and real interest rate is an interest rate that is not also affected by inflation. So you must marry both of them together. It's very important. Then the next one, now say that because inflation affects financing needs, is also likely to affect gearing and so cost of capital. So now let's now look at the relationship between money rates, real rates, and inflation. We're going to look at the relationship between money rate, we are looking at the relationship between money rates, real rates, and inflation. So I told you that one of the rate is what they call the money rate. The money rate, somebody should unmute. The money rate, what kind of rate is the money rate? Who can tell me? What kind of rate is the money rate? Who can tell me, please? If they say a rate is in money terms, what does it mean? Am I alone in this class?
It means it is already inflated. That means the nominal is a nominal cash flow.
Okay, I'm not actually talking about cash flow now. I'm talking about rates, or maybe like discount factor. So when they tell you that the discount factor is in money terms, that means that it has been affected by inflation. But when they tell you that the rate is in the real terms, that means that this rate has not been affected by inflation. Is the rate as at today. So you also know what the inflation is. So now for this thing, we have M. M is representing inflation. So it's representing money rates. Okay. R is representing the real rates. Then I is representing inflation. So I'm going to use it for this formula. Okay. In this formula, in order to be able to convert, to change a rate from money rate to the real rate, this is the formula we have to use. If you also want to change from real rate to money rate, you can also use this formula. So what it means is that if you ever check the question you are giving, is that in your question, are your cash flows, are they in money terms? If your cash flows are in money terms, then you also go and check, what about the discount factor we are giving? Are the discount factor or the inflation, yes, the discount factor or the rate you are giving, are they in money terms? Okay, are your rate in money terms or are they in real terms? So you need to now marry them to each other. Money, the discount factor or rate should be married to money cash flow now, and so on and so forth. So you use this formula. You say 1 plus the money rate, okay, equal to, that means that this 1 plus the money rate, to get it, is equal to 1 plus the real rate, open bracket, 1 plus the inflation rate. Okay, so you can always collect like terms to get the one that suits you. Now they say, note, if my cash flows are nominal, okay, the discount factor to use. Remember, if my cash flows are nominal, remember, this is very important. This is what I say you should take concentrate on. If my cash flows are nominal, okay, they now say that the discount factor to be used must also be nominal. The discount factor to also use must also be nominal. I thought somebody wants to join the class. The discount factor to also use must also be nominal. All right. So let's continue. Okay, now must also be nominal. And if my cash flows are real, if they are in a real term, the discount factor to use must also be the real discount factor. So you can see now that you see that cash flows nominal multiplied by discount factor that is nominal. Cash flows that is real should be multiplied by discount factor that is real. That's a if, however, they say if, however, okay, they now say if, however, they say if, however, okay, you have a nominal cash flow, but the discount factor in the question is real discount factor, then you have to convert the discount factor to nominal by using the Fisher's equation. So this equation that you have over here is what we call the Fisher's equation. And that is what we have over here also. The Fisher's equation says 1 plus the money rate equal to 1 plus the real rate plus 1 times 1 plus the inflation rate. So let's look at an example now. Okay, an example. We're going to look at the example before we now go to the big example. Example: a company has a nominal cost of capital of 18% per annum. Okay, it has a nominal cost of capital of 18% per annum. Please, what time are we to be done with this class? A company has a nominal cost of capital of 18%. Okay, now then that's a required. If inflation is 6%, okay, each year, you know, we are trying to look at the Fisher's equation now to understand it. A company has a nominal cash flow of this 18%. All right. So if inflation is 6%, we are trying to use this formula now. Each year, calculate the company's real cost of capital. We are told that a nominal cost of capital. Now, the reason why we can decide to change from a nominal cost of capital is either the cash flows that we are giving is not in nominal terms. Maybe the cash flow we are giving is in real terms. So, and now they are telling us that the nominal cost of capital we are giving the question is 18%. Now, they also give us inflation rate of 6%. Now, because the cash flows that you are giving is not in nominal terms, the cash flow is in real terms. So you need to calculate the company's real cost of capital. You need to calculate the company's real cost of capital using that Fisher's equation. Using Fisher's equation. Okay. I can't see who wants to join. Okay, admit all. Admit all. Sorry. Okay. So as I was saying, now because the company, because in the question we have a nominal cost of capital, okay, then we now assume that in the question they also gave us a real cash flow. Okay, you will discover that this nominal cost of capital cannot be used to discount that cash flows. So what you need to do is that you need to change this cost of capital from this nominal term. You need to now change it to the real cost of capital, and that is where the Fisher's equation comes to play. They've given us M is the money terms, okay, which we already have. The money term is 18%. R is what we are looking for. We are looking for R, okay, because they told us that we should get the real cost of capital. Now, they also told us that to the nearest 0.01%. Then they've given us inflation, okay? So what we need to do is that we need to now put all these things in the formula. So now, using Fisher's equation now, what do we want to get? We want to get the real cost of capital. We want to get R. We want to get R. We've been given M, okay? We've also been given inflation, okay? Our inflation is 6%, okay? Our M, which is the money term, is 18%. So using the Fisher's equation, we now say, what do we say? 1 plus 18%, right? That is yes, so that is 0.18, okay? That is what is going to give us this over here. So 1 plus 0.18, for people that don't understand mathematics, let me work it out for you. So here we say it's going to be like 1 plus it will be, you know, when you divide 18 by 100, you have 0.18. Am I right? People that don't understand mathematics, am I right? You're not answering, though. So you all assume that you understand mathematics. So then we now have 1 plus the inflation that we are giving in the question is 6%. So that would be 0. Am I right? 0.0606. So that is it. So when you do this, okay, when you do this, I don't know, maybe I should put this one under. Why you do this like this, okay? Let me push it forward so that you understand that this is what we have here. So once you do this, the next thing you now do is that you now collect like terms, right? Because we are looking for R, we want R to be a loan. So what do? You can divide both sides by 1 plus 0.06. So that's what we did here. Yeah? So that's what we did here. Yeah? So we now say 1.06. Okay, we divide both sides by this amount so that R1 plus R can be a loan because we are trying to get what R is. Okay, so we now divide both sides by this thing here. So that is what is giving us 1.18 divided by 1.06 is equal to 1 plus R open bracket 1.06 divided by 1.06. So 1.06 we cancel each other. So 1.06 we cancel each other. So this cancel this one. So if this cancel this one, then we now say 1.08 over 1.06 equal to 1 plus R. So what do we now do? We now open the bracket. Okay, we open the bracket. We now say R equal to 1.18 divided by 1. This. Okay, minus 1, because the one that this thing has before was positive. So if it's going to cross the equal sign, this one is going to now become negative because it's crossing the equal sign. So we now say R equal to 1.18 divided by 1.06 minus 1, because this is 1 plus R. This R here is a positive R1. Sorry, this one is a positive 1. So if it's going to cross the equal sign, it will change to negative. So that's why we have R equals to this minus 1. And that is how we got this amount. So you can discover that this one now is what we call the real interest rate. What we're given in the question was the nominal interest rate, but we've been able to get what the real interest rate is by using the Fisher's equation. Do we understand it, everybody? Do we understand it?
Hello, good morning.
Yeah, good morning.
Sorry, I joined a bit late.
Okay.
I might have to draw you back a little bit. I just want to know the difference between the nominal rates and the real rate. You can just help me explain this. Yeah, thank you.
All right. So yeah. So as I said, let me just take you up. You've actually missed a lot, but the good part is that this class is recorded. So everything that has been taught today, once the class is over, just expect it at the close of business. So this is what we are looking at. There are a lot of things that you need to consider when we are looking at NPV. Okay, NPV now, net present value. There are a lot of things you need to consider when doing NPV. Number one, you need to look at the activities that you need to consider when doing NPV. Okay, you need to look at what we call this the numbers of years of the project. This will be gotten in the question. You don't need to calculate number of years. You will also be given the relevant cash flows. Okay, we've looked at all those things that are relevant. What are the relevant cash flows? We've looked at them in this our training period. Then we are also now looking at the appropriate discount factor. So now for the fact that they say appropriate, that means that there could be a discount factor that is not appropriate for your calculation. So there could be a discount factor that is not appropriate. How do you discover? How do you know the discount factor that is appropriate? How do you also know the cash flows that is appropriate for what you are doing? Because you could get some cash flows. Okay. Number one, the first thing is of us select all the cash flows that are relevant for the competition. Then the next one, also now get the appropriate cash flow that you should use, because your cash flow may have been inflated, okay, or your cash flows is either, when they say your cash flow is inflated, that means your cash flow is in money terms, okay, money terms. So, or your cash flows could be real, it could be in the real term. Okay, so now when I went there, we first started by looking at the relevant cash flows. We talked about incremental cash flows. We talk about it must be incremental, it must be avoidable. Okay, we talk about opportunity costs, we talk about those things. So I will not try to draw us back here because I want you to go to the recorded video to get it from the beginning. But however, since you asked for this, now we are under inflation. We are under inflation, okay? And how inflation affects a project. We tell you that inflation can affect the revenue or the cash flows, the return phase cash flows. Inflation can affect it, okay? That's what they call the revenue for the project or the sales that you made in the investment. Inflation can also affect the cash flows, the investment phase cash flows, those cash flows that you incur when you were trying to start the business. So inflation can also affect it. Then inflation can also affect the discount factor. So we need to get all those relevant things that we need to know. I told you, whenever they say your cash flow is in money terms or nominal, know that your cash flow has been inflated. Your cash flows has been inflated. So that is what money cash flow is. Okay, your cash flow has been inflated. There's a formula that we also use to convert cash flows from money terms to real terms. I'm going to tell us that later. So this is a money, when they say a cash flow is in money terms, that means the cash flow has been inflated. Inflation has affected that cash flow. Because remember, when there's inflation, workers, they want to earn more money. Workers now say, okay, since our salary before was 500,000, now there is inflation. Cost of everything in the market has increased. So you need to increase our money. There is 5% inflation in the market. So increase our revenue also to have that effect of the inflation. So they have to gross up your revenue by the 5%, so that you can cater for that inflationary aspect of that cash flow. Okay, so that is money. When they say your cash flow is in money terms, that means your cash flows have been inflated. But when they say your cash flow is in real terms, that means that your cash flow does not have inflation. Your cash flow is as of today. It's expressed as of today. It doesn't have any inflation. We also look at the relationship between money interest rates and real interest rate. Okay, and also the relationship between money cash flow and real cash flows. They tell you that whenever you are using money interest rate, okay, make sure that you are using it for the same type of cash flows. If you are using a money or nominal rate, you should use that rate to discount a nominal cash flow. Don't use a money rate to discount a real cash flow. No, use to discount a nominal cash flow. Then the next one, we also say that real interest rate should be used to discount real cash flow. Okay, it should be used to discount real cash flow. So we started this class by 9:30. Am I right? So what is the time now? 11:39. 9:30, 10.
Yeah.
Our class is over.
I didn't know there's a change in timetable. They wrote 12 p.m. to 2:30 p.m.
Oh, sorry.
Wow.
I apologize. But I dropped on the group that people should join. Okay, no problem. No
Yeah,
problem.
but I wasn't really checking my charts. I just let me look at it now, and I saw that you guys have already started because I was following the timetable.
Okay,
So if
sorry
there's
about,
a change, we should communicate that with us.
I'm so sorry.
So
I
no problem.
apologize. Okay. So thank God that the class is recorded. Okay, you can always have access to it. So now, yeah, we look at the relationship now. We say that a money cash flow or rate should be used for a money cash flow or a nominal cash flow. Then a real rate should also be used to discount a real cash flow. Now they say that then what is the next thing? We also look at the relationship between the money rate and the real rate and inflation. What is the relationship that happens between money rates? For instance, when they give you a discount factor that is in money rate that has been inflated, okay, and then they are telling you to get a cash flow, a discount factor that is in the real terms. Well, how do you change from these money terms, from this inflated rate? How do you change to a rate that is not inflated? Okay, so that's where Fisher's equation comes to play. Fisher's equation tells us that 1 plus the money rate, okay, or the inflated rate is equal to 1 plus the discount, the real rate, sorry, close your bracket, multiplied by 1 plus the inflation rate. Okay, now what else did I say? What else did I say? Okay, I say if my cash flows are nominal, the discount factor to use must also be nominal. Then I say if cash flows are real, the discount factor to be used also should be real. Now that is the multiplication here. So then I say that if, however, you have a nominal cash flows, but the discount factor in the question is real, that means that you have to use Fisher's equation to convert that money cash flows back to the real cash flows. Now, how does it work? In a question, they can give you cash flows. The cash flows now, they can tell you that the cash flows are in real terms, but they now give you discount factor. The discount factor they are giving you, or the cost of capital they are giving you a cost of capital that is in money terms. You see that they cannot marry each other. One is in money terms, the other one is in real terms. So you cannot use a nominal cost of capital or money cost of capital to discount a real cash flow. Why? Because money cost of capital has been affected by inflation. Why a real cash flow is not affected by inflation? How can you use something that is having inflation to discount something that does not have inflation? So in order to be able to make it agree, you need to bring them to their same level, okay? You need to bring them to their same level. So how do you do that? How do you do that? So you use Fisher's equation. That's where Fisher's equation comes in. Fisher's equation says that 1 plus the money rate is equal to 1 plus the real rate, okay, into bracket 1 plus the inflation rate. All right. So now we are looking at this question. The question we have on the board here is for us to learn how to do that conversion. It's very important so that we don't just meet it in the question and then we are confused. Now, when you have, they say a company has a nominal cost of capital of 18%. So this cost of capital that it has is nominal, is an inflated cost of capital. Now, let's not assume that in the same question, you are to use this cost of capital to discount a real cash flow. So if you are going to use this nominal cost of capital to discount a real cash flow, you discover that it cannot work because this one has inflation, while the cash flow does not have inflation. So in order for it to be able to work, what you need to do is that you now use the Fisher's equation to change this your cost of capital from being inflated to being deflated. You take away the inflation. How do you do that? The formula 1 plus the money rate equal to 1 plus the real rate into bracket 1 plus inflation. So mathematically, how do you apply it mathematically? What is our money rate? Our money rate was given in the question is 18%, right? So that means 1 plus M equal to 1 plus 18% equal to, then we have 1 plus R. Do we know what our real rate is? No. That is what we are looking for. That is the variable that we are looking for. We are looking for R. So since we are looking for R, then we move on. What is the next thing that we have there? We have, we are looking for R. So, but we have 1 plus inflation. In the question, they told us that inflation is 6%. So it will become 1 plus 6%. 6% is 6 divided by 100. Okay, if you divide 6 by 100, you are going to get 0.06. So mathematically, you now say, since we are looking for R, since this is what we are looking for, so you now need to now say, okay, collect like terms, okay, as they say it in mathematics, you now say to make R to stand alone, that means that you need to divide both sides by 1 plus 0.06. So you divide both sides by 1 plus 0.06. So when you do that, you discover that the 1.0.06 that's under this thing will make you to cut this with what is under. So let's look at it now. We now divide both sides by 1.06. Okay, so this one here now, this one that is here, okay, we cut this one. We cut this one to make 1 plus R to stand alone. So it will now become 1.18 divided by 1.06 equal to 1 plus R. So you can also see collect like term. When you collect like term, R stays alone. So you now say R equal to, because this one here is a positive figure. So if it's going to cross the equal sign, it changes to a negative figure. So we now say, okay, R equal to, you know, this one is coming to this side now. You now become 1.18 divided by 1.06 minus 1, because 1 is crossing. It's coming from here, it's crossing from here, and it's coming over the equal sign. So it's going to change from positive, it's going to become a negative 1. So when you do that mathematically, you have 11.32%. Do you understand it now, madam? Madam, can you hear me? Hello?
Yes, I understand. Sorry, I was muted. Yes, I understand now.
Okay, you understand it now. That's
Thank you.
good.
Yeah,
Okay.
yeah, thank you.
So okay. So we are already done with this class. Okay, so I will stop the recording now so that it doesn't affect what we've done. Then I will now go straight and look at our what's it called? Our advanced tax. We look at it, just look at an overview of it, and then I'm not the one that is going to take it. I am not the one taking it. So I'll just look at it, introduce it to us, and the teacher that is going to take it will come and take it. So I want to stop recording. Do we have any question to ask before I move on? Before we stop SFM? Hello?
No question from my end.
All right. So let me stop the class now.